Join TWR in 2023. TWR Tech Video.
I'm on it. Hey, you know I'm on that though, man. Y'all, come join it. In the traders war room, warring with the market every day. We on Zoom. Yeah. Never gonna quit. Ain't no way we gonna lose.
TWR is your one-stop shop. Maximize your ROI. So let's talk about what is return on investment, or ROI. So a calculation of the monetary value of an investment versus its cost. The ROI formula is profit minus cost divided by the cost. So, for example, if you made $10,000 from a $1,000 investment, your return on investment, or your ROI, would be 0.9, or we're utilizing percentages for 90%. This can also be usually obtained through an investment calculator, which there's plenty online that you can find, but ROI can be useful to assess the potential profitability of a particular investment. Now, I want you to think of your investments like a business or a company, in that they're resources you put into to improve your company, like time and money. The return is the profit you make as a result of your investments. So ROI is generally defined as the ratio of net profit over the total cost of your investment. ROI is most useful to your goals when it refers to something concrete and measurable to identify your investment gains and financial returns. Analyzing these investments in terms of monetary cost is the most popular method because it's the easiest to quantify, although it's also possible to calculate ROI using time as an investment. The ROI metric, or ROI figure, is also applied across different types of investment and industries: return on equity, return on ad spend, return on assets, social return on investments, etc., etc. So now let's talk about how to calculate ROI. So ROI is calculated as the net profit during a certain time divided by the cost of investment, which is then multiplied by 100 to express the ratio as a percentage. The basic formula is ROI equals net profit divided by your investment times 100. The value of net profit should be taken from your profit and loss, or your P&L statement. So why is ROI important? Well, calculating an ROI can help you understand how an investment directly contributes to your business, company, or investments. This is a useful tool for evaluating your past business decisions and informing future ones. You can also utilize the information from ROI calculations to compare new business opportunities and decide which ones to pursue. If a certain kind of investment returns a high net profit, you can focus more time and energy on similar investments. Investments that don't generate enough profit to cover their costs can indicate that you should try a new strategy or invest in a different area of your business. Now, there are challenges to determining ROI. Calculating the ROI is not always clear-cut. Some investments may overlap, making it difficult to determine which investments generated the most profit. Despite the potential difficulty of determining the ROI of a specific investment, the metric is still very useful when trying to ensure you earn more than you spend. Now, don't worry about complete accuracy when calculating the ROI. Instead, consider how you'll be able to measure results each and every time you make a new investment, utilizing that similar strategy or other strategies. Now, how to increase your ROI? Well, depending on the kinds of investments you want to make, the best way to increase returns will change periodically. However, there are a few universal strategies you can try out before making investments to better your chances of getting a high ROI. Analytics have to be your friend. When considering an investment requiring the use of a platform or external software, pay attention to reporting features that different providers offers. Statistics are particularly useful when measuring the success of an investment because they show if the current strategy or plan is effective, and many times how effective that plan or strategy is. Another one of your friends is knowledge. Investments that will deepen your knowledge and understanding will likely have high returns because these are things that lead to consistency and profitability. Reviewing success and losses and breaking down what worked and what didn't are important to gain competency, allowing you to repeat things that worked and either discontinue or refine things that failed. Finally, You have to be willing to experiment. The real test of any idea's value will come in the market, so don't be afraid to try something that doesn't come with a tried and true track record. Start small with more experimental tactics, and you can measure ROI over a shorter period of time to test whether an investment is worth expanding on. The more practice you have with thinking about your ROI, the more refined your decision making will become. ROI is only a single performance metric, but it's one of the most essential tools to get the most out of your investments. Now let's talk about what is a good rate of return. Well, there isn't just one answer to this question. A good, quote-unquote, ROI depends on several factors. The most important thing to consider in determining a good ROI is your financial need. For example, suppose you're a young couple and you're investing to pay for college tuition for a child. A good ROI for you will be one that enables you to initially and ongoing investments to grow enough to pay for college expenses 18 years or so down the road. Now, this young family's definition of a good ROI would be different from that of a retiree who's seeking to supplement their income. The retiree would consider a good ROI to be a rate of return that generates sufficient recurring income to enable them to live comfortably. It's also important to consider what you're investing in to evaluate what would be a good rate of return. So let's expand on that a little bit. The following table shows compound annual growth rates, or the CAGR, rates of return that assume all profits are reinvested for several major popular investment assets from 1926 through 2019. What we're looking at here is the asset type being treasury bills, government bonds, large cap stocks, and small cap stocks. And the compound annual growth rate, we can see treasury bills at 3.3%, government bonds at 5.5%, large cap at 10.2%, and small cap at 11.9%. So these are different historical rates of return, underscore a key principle to understand. The higher the risk of a type of investment, the higher the ROI investors will accept. Is a rate of, say, 8% a good average annual return? Well, the answer could be yes if you're investing in government bonds, which shouldn't be as risky as, say, investing in equities. However, many investors probably wouldn't view an average return of 8% as a good rate of return of money invested in, say, small cap stocks over a long period of time because such stocks tend to be risky. So when we get back into this expectations for return from the stock market, most investors would view an average annual rate of, say, 10% or more as a good ROI for long-term investments in the stock market. However, I want you to keep in mind that this is an average. Some years will differ with lower returns, perhaps even negative returns, and other years will generate significantly higher returns. So let's take a look at this. For example, the following chart shows the S&P 500 returns from 2010 to 2020. This chart illustrates the kind of year-to-year volatility investors can experience within the stock market. In 2 of the past 11 years, the S&P 500 had a negative return. In 2011, the index delivered a 0% return. In 2016, the S&P generated a positive return of 9.5%, but that was below the good quote-unquote ROI of 10% that we're looking for. Even with these subpar years, the S&P delivered a CAGR of 11.4% during this entire period, which of course is above our good ROI. So what we get is this combination of year-to-year volatility and long-term attractive gains underscores why a buy and hold type of strategy offers investors a better chance of achieving a good ROI. You might lose money in any given year investing in stocks. Selling during those times, though, prevents you from benefiting from the bigger gains later on. If you buy and hold stocks over the long term, your prospects for generating attractive returns greatly improve. So let's now talk about short time frame expectations. Most newer investors lose significantly more than they earned before gaining consistent profitability. I myself have blown up trading accounts for complete wipeouts 3 times since I started trading in 2005. However, with experience comes competency and clarity of strategies for the current market. When we're talking about short time frame expectations, a good ROI for shorter time frames would be about 1% or 2% gain on your overall account per day. At times, percentages may not be used for longer time frame. Dollar amount might be easier to track. In that respect, I always aim for $100 to $1,000 per day, with consideration for anything over $25 profit for scaling or trimming, as sometimes the market will be choppy, and as we all know, green is green, and you want to take things to the bank. So wrapping this up, let's go ahead and get into the conclusion. We invest to make money. Let's not beat around the bush, okay? That is the main goal, to make money. Whether it's for retirement or for college or income, the goal is to make more than we spend. ROI is important because this is a metric that we can track if a strategy is working and how effective that strategy is. Constant evolution over time is needed, and only those who are dedicated will truly prosper. You might get the occasional lucky call like the Dogecoin or the GME type of situation, but the consistency of the dedication is going to pay the bills over time, every time. Longer-term investments have a benchmark of 10% as a good ROI. Short-term investments, we're looking for the 1% to 2% increase over our total account while we're actively trading. And newer investors with smaller accounts should look to earn $100 to $1,000 per day, with absolutely considering taking profits or trimming and scaling back positions at $25 or more. Check out our upcoming classes. And we go live tomorrow, guys. Join Traders War Room and learn how to scalp the market utilizing basic indicators. Our 7-figure mentor is back to teach you guys all the secret sauce that has made him a fortune over 35 years of trading. This class is a day trader's dream, and if you've never done a Traders War Room class before, this would be a fantastic class for you to get your feet wet. You can register at the links in the description or go to traderswarroom.com and register right there. $15 gets you a seat, and every purchase gets the recorded copy. I'll see you in class tomorrow. And then 2 weeks after that, kicking off on 5 February at 1 p.m. Central Standard Time, guys, we are going to have a fantastic class that's going to teach you the emotional side of trading and how to manage risk associated with actively trading. This is a must-have class for every serious trader and investor out there, because if you cannot master your emotional connection to the money that you're investing or utilize the proper risk management tools, you will fail every single time. And this class is going to give you those tools to make you consistently profitable and to be calm, cool, and collected while you're actively trading. Hope to see everyone there. 5 February, 1 p.m. Central Standard Time. Again, $15 gets you a seat, and every purchase gets their copy. That's a wrap, team. Don't forget, make the market bend the knee in 2023. Join Traders War Room and bow to no one. The link is in the description, or you can go to the website at traderswarroom.com. Let's go to war.